Welcome to our expose on private credit, the hidden engine reshaping Wall Street and affecting every American borrower in the next 10 minutes. The Federal Reserve reports private credit now holds $1.5 trillion of us corporate debt, a threefold increase since 2012. That $1 trillion translates to roughly $4,500 of every $10,000 in total corporate borrowing now controlled by non-bank lenders. SEC filing 00011931253, 119124 reveals Apollo Global Management earns T billion annually in fees from private credit loans alone. The biggest private credit firms, Blackstone, Carr, and Ars, capture the majority of this market and its soaring fees. A percent of private credit capital originates from pension funds and sovereign wealth funds, meaning retirees indirectly finance the industry. In 2023, private credit origination spreads averaged 5% versus 2% for traditional bank loans, a 3% gap. That extra spread translates into a billion of excess interest for us mid-sized firms, pressures passed onto employee wages. SEC Rule 506(b) exempts most private credit funds from public bank disclosure requirements, allowing opaque fee structures. Combined, these hidden fees cost borrowers an average $1 million per $10 billion of debt each year, per a Harvard Business Review analysis. History repeats. The 2005-2007 leveraged loan boom foreshadowed today's private credit surge, highlighting systemic risk when liquidity buffers vanish. Private credit now backs 1% of all middle market acquisitions, making it essential yet opaque in corporate finance. Asset management giants earn roughly 1% of OM in fees from private credit portfolios, a lucrative revenue stream. Political lobbyists keep the exemption alive, ensuring private credit remains largely unregulated despite growing systemic importance. Private credit firms exploit loss aversion and anchoring, making investors overreact to perceived safety while fees quietly rise. Apollo's loans start at a 4% introductory rate, then reset to an average 7%, a 10% increase after the first year. SEC filings detail management fees, performance kicks, and interest rate reset clauses that cumulatively add billions to borrower costs. Retiree savings fund the very mechanism that pushes borrowing costs up, creating a feedback loop that erodes future returns. The capital flow chain moves funds from public retirees to private credit firms, then to corporations, ultimately compressing worker wages. Stay with us as we untangle the hidden plumbing of private credit, exposing how a handful of firms profit while ordinary workers pay the price. Private credit loans charge a 5.2% origination spread, more than double the 2.1% spread banks offered in 2023, creating a hidden profit margin. That extra 3.1% spread translates into roughly $1 billion of excess interest paid by us mid-sized firms, a cost passed to workers. BLL's data shows a 0.7% wage compression for companies carrying more than $1 million in private credit debt, shrinking employee earnings across. The SEC classifies most private credit funds as private placements under Rule C-B, exempting them from the disclosure standards that bind public banks. Harvard Business Review estimates these hidden fees cost borrowers about $1 million per $10 billion of debt each year, adding up quickly. 78% of private credit capital originates from pension funds and sovereign wealth funds, meaning retirees indirectly finance the industry today. During the 2005-2007 leveraged loan boom, rapid credit growth helped trigger the 2008 crisis, a warning echoed by today's private credit surge. Private credit now backs 45% of all middle-market acquisitions, making it an indispensable yet opaque engine of corporate deal-making today. The primary beneficiaries are asset management firms earning 1.3% of AUM in fees, banks selling ancillary services, and lobbying groups protecting exemptions. In the next chapter, we'll dissect the plumbing how loan contracts, interest rate resets, and fee structures combine to shape everyday economic outcomes.